We're good to go. Okay. Well, hello everyone, and welcome to the Summerwood Place quarterly webinar update. I'm Isa, and today's presentation will be held by Sam. If you have any questions, please feel free to type into the chat box below. And after the presentation, there will be a Q&A as well as a survey. Without any further ado, let's begin.
Rather unfortunate sound at the end there. Good morning, as I said, good morning everyone. Hope you're well, and looking forward to presenting to you this preview update, quarterly update. Hoping that this will be around about 20 minutes or possibly a little bit less. But we have good performance that's been over the last recent periods. So look forward to going into that a little bit more. Just a reminder as to the format of these, go through a reminder of although we have a redemption process and timelines, it's always good to outline that. By redemption process, we mean if one wanted to sell the shares that they hold in Summerwood Place, there is a process by which we undertake this. Also, the process to wind up a vehicle and the timelines involved in that, in allowing all the loans to redeem. Obviously, we are tied into fixed contracts as part of being a lending business. You know, we lend out for fixed-term contracts, so we have to wait for those to wind down before we can wind the vehicle up, if that, for example, was something that everyone voted for. Before we move on to the current situation and current performance, and whether or not you wish to lend money into Summerwood Place. So we do now also, as well as the equity side of things, we do also accept lender capital in. Although we have done this and we have had lending amounts come in, at present we have no leverage within the firm. So the only capital in the business is the share capital. So at the moment, we are as unlevered as we possibly can be. We will also cover what the options are for the director, being Mark Inslee, in situations where there's heavy requests for those equity redemptions that I've previously mentioned. So just to outline what we will do to make sure that things remain fair for all stake parties there. And making sure that no one unduly were to benefit. And then normally, if I say we do an IHT refresher, and then we'd go over the AOB, etc., or any questions and answers that you may have and wish to ask me. So should one wish to sell out from Summerwood Place, first thing to outline is that as a private limited company, obviously there isn't a formal market for redemption for the sale of shares. However, we have a process that we go down, and we have trodden this route before, and we find that this works pretty well and keeps everyone aligned for same outcomes. So first of all, if you were to ask for your equity capital back, we would offer this out to existing shareholders. In the shareholder agreement, there is a right of first refusal in there. That goes out for a 3 weeks offer, plus the time for parties to complete. If that's at 3 weeks lapses without any interest, we go to prospective shareholders. There is always interested parties that we typically find. However, if that doesn't get taken up in 3 weeks, Summerwood Place would seek to purchase your assets out of our own capital. So in essence, that's us buying back your shares. That's an indefinite time frame, just due to the fact that we have to wait for loans to redeem for us to pay you back your equity. But no one has more than, I think the biggest shareholder has around about 18% of the capital in the vehicle. So that would be, even in that extreme situation, that would be at most a year. But the vast majority of people, that would be well within 6 months, just because you've got to wait for some pieces of paperwork with Companies House, etc., and there's waiting periods involved. But in realistic terms, I'd say that if if this was, we would know at the start of going out to external parties whether or not this was going to be wound up quickly. So we would already have it so that we could try to wind this up within 3 to 4 months. And as I said, this is a process we've already gone down on 2 or 3 occasions. So we're well trodden on this, and we are familiar with any hurdles that can come up. If we were in the situation to have heavy requests for equity redemption or sale, not that we've ever come across this, we want to make sure that all shareholders' interests are as maintained as possible. So if, for example, we were to have, say, over 10% of a portfolio value, as for redemption in very short order, as directors, we have Mark has the possibility to gate redemptions, just because the reason for this is that if we end up with too many redemptions in a short period of time, in essence, whilst we can try to sell our loan contracts to other persons, after a while, obviously, you're starting to try to sell off even the good parts of the portfolio to try and meet these redemption requests. So therefore, we say no. Look, we'll make sure this gets done in an orderly fashion to make sure that what is left is still a very good book for the equity holders, and so we make sure that this gets done in a managed fashion to protect everyone's interest very much indeed. If this process does occur, a continuation continuation vote on the business will follow. The reason for this is that obviously, if we would obviously seek out for reasons why the sales may happen. It might be due to a death of the equity holder, and whoever's inheriting their stake doesn't want to maintain it. That's quite plausible, but still we need to find out in this situation, is everyone okay for this vehicle to carry on? If there is, the result of a vote is for a cessation of the business, we would seek to undertake to redeem all equity out of capital as and when loan redemptions take place. Interest payments, though, in this situation would only pay out when a loan redeems. The majority of loans are certainly 5 years less. That's actually wrong saying the longest has 9 years remaining. I think now the longest has 7 years. But the vast majority of contracts, I think, are sub 3 years even at the moment. So if there was a wind up, it would be very orderly, and we do so. In a vote against a wind up, then Mark, as director, would decide on redemptions will continue. This would be when, once we've got below that threshold figure, typically, and there's possibility for, in such a situation, that you as equity holders, we would propose out for this to occur. Obviously, we wouldn't expect you on a peer-to-peer basis or try to network. It would be quite difficult. Agree a new element, perhaps from the shareholders agreement or from a series of meetings. But we, as I said, we've not had to do this, and we certainly don't see the need for that to occur anytime soon. Quick look at the book update. So in terms of what we hold via PropLend platform, what's quite interesting is out of all the currently overdue PropLend loans, we are exposed to only one of them, and that's the Balby Industrial Refinance. PropLend aren't offering refinance, but they are supporting the refinance away to GB Bank. That's looking like it's going to be December at the earliest. That isn't particularly uncommon within the commercial loans, property loan space. What's important here is that obviously, whilst we've gone past that due date, this is accruing default interest on 1.5 times. So we're getting circa 10% per annum on this, but this makes up less than 1% of net asset value. We're a very well diversified book. Looking across the Bridge Invest, whoops, sorry, forgot to update the formatting on that bit there. So now Wani Stanmore was literally due for a payment less than a week ago. The platform have offered an extension on that one. The borrowers had various loans via that platform in the past and currently, and they are in good standing. As I said, you know, it's quite typical for loans in the commercial and bridging loan space to overrun just due to, as I'm sure you know from when you pull properties, legals and that kind of thing often hold things up frustratingly. So that isn't uncommon, and this is expected to have an extension which we support in this case. That we know who the lender is, that they've been very good in the past. Combo Keston, so this one was due in April. We've seen evidence, quite a lot of evidence, that the broker is engaging with the refinancing, etc. And you know, this is at an advanced stage. But to keep pressure up, investors applying pressure through letters before action, just very much at that, you know, keeping the pressure on the borrower there to push things through. As much as borrowers may be generally good standing, it's good to remind about ultimately the contract was for April, and therefore I review that now. Rock pool loans. The PKMG loans, this is a tiny pump out of the book. It's of the circa 13 million that's in more places now. This is about 50 grand, makes up less than 0.1% of the asset, sorry, 0.4% of the net asset value within the business that's been pushed back to this quarter. I'll get an update soon though on that there. Loans are beach equity. All of good standing. They got a couple of years to go yet, and direct. So last update, I mentioned that we had one loan of poor standing, and we were very much putting pressure on that there. So this was for a bridging loan at 70% LTV against a residential property, and finding that the borrower was, you know, kind of given the sob story of like, I don't want to sell into this market. It's like, dude, in the most possible way, I care about the, you know, you've made a contract with us, you need to fulfill on that. Fortunately, we had the help of a mutual contact that proved to be very useful in helping apply pressure. Their full repayments of capital and interest resulted from that. That occurred, I believe, end of July. That's proved to be very good indeed, and that's ended up being on a residential property at a 10% per annum return on that. I think slightly less than that, but it worked out to be a very good return for the book there. So looking at how this is impacted us over the period. Surprisingly, I didn't quite realise until I did this that actually it's been a very good 3 and 6 months for ourselves. Looking at the annualised numbers there down at the bottom, circa 6.75% annualised return over the last 3 and 6 months. So we're very happy with that indeed, considering our target rate is 5% plus. End of last year was a little bit slow. Don't get me wrong, it was certainly a good year, but it had a quiet few months there. So on the 12 months there, we were 5.87, but as you can see, let me see if I've got my, I have got my marker. You know, last October, November, December, and January, sorry, not November 1, were all quite small dividends. So we expect us to lift up that figure over the next few months to get that into the sixes, which would be a really good return for the year on the business. After all, you know, these figures are quoted net of corporation tax, so that's a nice net yield there. Obviously, it depends on how you hold the equity on your personal taxation front, but very good there from our standard, particularly when we look at versus our peers over the last 12 months. So in brackets was when the previous figures that were released by the firm or were ability for us to calculate. And on the left is calculated. That's actually, I updated these again. I noticed there was a couple outstanding just before call, so excuse me whilst I bring up the latest figures. These will be the ones that'll be distributed in the slide pack. So actually, rather than the competitor average being a smidge over 2% over the last 12 months, when calculated briefly first thing this morning, was waiting for a couple of people to come in. Last 12 months on the competitors was 1.79%. So when you compare that to our current 5.87, you know, really happy with that. That's 3.25 times for competitor average running rate. So really happy with that one. And importantly, you know, compared to say Octopus, we're not looking at a loss, which is certainly something that we seek to avoid. We're coming up in the next 2 weeks. It'll be 5 years since Summerwood Place came into being to its normal operations. And touch wood, we haven't had a single instance of a capital loss or even loss of interest since we started. We've had full capital and interest payments, and that includes June 2022 when the market in lending in this kind of space was not as calm as it is right now. It's not saying it was bad, it was just you finding a few more of the speculative loans were defaulting, which we tend to typically avoid. We tend to be quite prudent in how we do this, but at the same time, a lot of these firms, they charge an awful lot in fees, and as you can see, it makes a big difference on the rate of return to equity holders. So we're really happy with how we performed over the last 12 and actually 2 years on that one, been really nicely performing. When compared to looking at literally instantaneous, as we sit right now, we see that before taxation, we're looking at 8.45% yield on the book after management fees. Obviously, corporation tax, thank you, Rachel Reeves, brings that down to 6.34, which so that's if the book was to maintain exactly as it is right now for the next 12 months, we'd expect to return to you guys to be 6.34%. It has come down a tiny bit over the last month, about 0.07%. It's because we've had a couple of large loans paid back, which are at a fantastic rate. It's one of the unfortunate things sometimes in lending business is that you have a great loan with a great borrower that actually you don't want. In some ways, you kind of wish that they go over so that you keep it on your books for a longer period of time, because you know eventually they will pay it back. But it helps keep your return nice in the meantime. But ultimately, we'd like, obviously, the contracts to pay back to us so that we can prove the process works. When looked on an alternative platform, if you are a client of Vasco Wealth, you might be familiar with this one on the peer-to-peer. Looking at if you were to be holding us again in a similar structure, if after corporation tax would be 5.15% there, so a little over 1% difference, and they're currently got around about 6.8%. Of on that platform is held within cash, just the ability to get this cash into loans, whereas we're just sitting at 1%. Could realistically get that down to 0 very quickly, but at present I kind of want to be prudent and just try and select correct loans, and making sure that everything is working in shareholders' interests. Whilst not a direct proxy, just a quick comparison with the savings market here. So this was a 3-year fixed rate bond, which I picked as comparison. To be fair, rates are pretty flat across the board. So if you were to go for a 5-year bond, it's about literally, I think it's only a 0.05% difference. But 3-year bond is very similar in terms of what I said, our average loan book ages, and 4.47% there. So compared to where we are at the moment, we're close to 2% extra over and above a savings account, but this is in a personal name. This was in a limited company. If you hold your share capital in that kind of structure. A 1-year fixed rate bond, actually this didn't really change much based on how long. You're looking at 3.8%, so a 1.5%, more than 1.5% difference there. And that was, I think, just shows the value we're adding over and above for everyone. When reviewing this slide from the last webinar, I noticed actually quite how similar the space is at the moment, but then 3 months isn't an exceptionally long period of time. We are still having a situation where, although it's come back a little bit over the last couple of weeks, where the general trend of US Treasury, so that's US government debt, and similarly gilts, so that's United Kingdom government debt, and also pushing up higher yields, and what that typically will mean that is the environment for lending becomes not as liquid. So what that means is that not so much money is passing around. People might find it a little bit harder to find credit, particularly if the spread, so that's kind of like the extra part of interest rate that you pay for risk, widens out from what is right now a very low baseline. At the moment, what we're seeing in particularly the corporate space is that risk is cheap. And so that's making us very prudent at the moment what we lend into, just because we don't feel that necessarily the extra interest is being paid to represent that extra risk on the book. But if those high yield spreads open up and government debt continues to sell off, means that the greater rates being offered on loans to be originated. So we certainly expect that in around 12 months' time. If there was a hypothetical recession scenario, not that we're expecting that particularly soon, but in the US, and as the old adage goes, if the US sneezes, everyone else catches a cold, so we're quite aware of that. We would expect gilt yields to fall, which would reduce those bank saving rates. However, that risk spread that I mentioned would open up significantly. So therefore, our rates versus savings would open up an awful lot. But also the fact is that then, okay, risk becomes, you're being paid for risk. So we might choose that time to then, as things start to bottom out, to start adding a little bit more, say, higher loan to value loans in the portfolio. Typically, we tend to stay quite, as I said, prudent in how we allocate that. But on a net basis between the two, new loans rates would sit around about where they are at the moment. But in terms of that recessionary scenario, as I said, we're very prudent. The vast majority of our property-backed loans are secured at less than 65% loan to value. So you'd have to end up with, property values going down by more than 35% before we were to incur capital loss. Obviously, if they are residential, at 35% change in residential values on residential bridging, so that'd be 35% loss on residential prices in 12 months would be significant, and certainly not something that we have seen for at least 30 years. And we typically, when we lend out to businesses, we very much try those with what we call sticky revenue streams. So these are businesses that have long contracted revenues. They're not, determined by short economic events. These are things that, typically are support contracts. So we have a loan to, whilst everyone has been everyone's going green energy, it isn't necessarily the builders of the plants that you want to own. As a matter of fact, an awful lot of the wind power turbine manufacturers are struggling. But what is an interesting area is the servicing of those wind turbines. Obviously, as we get more and more wind turbines, that's an area that is growing quite a bit. And we lent to, so you might have heard one of the big players, what big manufacturers is called Vistas of wind turbines, and who we lend to is named as a preferred servicing provider for these wind turbines, and Vistas make a very significant amount of the wind turbines in the UK. So, wind turbines don't exist for like 5 years. These are turbines that will be around for a decade or two. So the contracts are quite long on this. So helps keep everything nice and stable over a longer period of time. So that brings us to the end of that. Thank you again once again to everyone for joining, and hope you have a good tail end of the year. Can't believe we're coming to the end of 2025 already. And let's hope we continue with the year as it has been so far. Over to you, Isa. You muted. It's only been 5 years since everyone started doing remote working in Zoom.
My bad, guys. Thank you for that presentation, Sam. We have not received any questions today. However, if anyone does have any questions, feel free to ask, and also be on the lookout for the copy of the recording and slides. And that will be it. Thank you, everyone, and enjoy the rest of your day.
Thank you, everyone. Have a good day.